Okay. Well, thanks for joining us, everyone. We are here for another session with our wealth strategy team. We're going to be talking about college planning. And in particular today, there's a lot we could cover. As I was talking with Derek and Kevin, we wanted to focus a bit on how we think about planning for college costs, some of the tools and methodologies we use. And then we're going to spend some time talking about updates on 529 plans, updates within the last couple of years. I've always liked these plans. We've used them since day one, came out in 1996, but there was a time when I think we viewed it as a legitimate trade-off between tax advantages of the 529 plan and some lack of control, lack of flexibility in terms of timing and use of the funds. But they've kept getting better and better and better over the last few years, to where I'd say we're even bigger fans now, and there's some new potential uses we're opening up and maybe expanding how we're thinking about 529 plans, whereas before it was maybe a somewhat cautious approach in wanting to really avoid the risk of overfunding these plans. So we're going to spend some time talking about that. So as always, our standard disclosure, anyone watching this, if you're viewing this later, is a recap. Our compliance team wants to make sure we point out that this is a general discussion. You should do your own research, make sure you understand how this applies to your specific situation, consult your own experts, or hey, give any one of us a call at the office when you talk through how it works for you. So with that said, our introductions, our team here. Derek Kecho, certified financial planner, Kevin O'Laughlin, also certified financial planner, and myself, we work together. We have shared client base, and we've made a concerted effort to come together more strategically in terms of helping each other sharpen the saw, work on our technical knowledge, make sure that we're up to speed on things instead of having it come kind of piecemeal through random continuing education, but very strategically think about where do we want to be really expert and sharp, and think about advanced planning opportunities and topics, and then take that research and that study time and share it with you on a one-to-many type basis. So that's what we're here for. And like I say, we could, a lot of things we talk about. College planning, I would say, is certainly one of the certainly top 5, likely top 3 planning issue that I've encountered and had conversations with clients over the years. It comes up frequently. A lot of people, it's very important, but there's a lot of different potential goals out there, a lot of things that are competing with. And I think one of the things that's interesting, Kevin and I were just having a chat. There are a lot of good articles out there. There's websites, there's books that talk about college planning calculators, tools, but that is an isolated goal. And what we're often seeing is it's one of many along the lines of retirement and career change and launching a business or buying the cabin or updating a house or helping parents out, and any number of things that come along a timeline in people's financial lives and have varying levels of certainty or uncertainty. And some are moving targets, some are fixed, and varying levels of priority or desire to make sure that these things happen. So it's a lot of interdependency in the goals and concerns in financial planning. So we're going to talk a bit about our planning process, and then we're going to spend the rest of the time really focusing on 529 plans and maybe some of the interesting updates that have got us excited again, or renewed interest in looking at how we're using 529 plans. So, maybe with that said, by way of introduction, Kevin has spent a lot of time really being our in-house expert in our planning tool that we're using to model out college cost. And as we're working with people over the years leading up to that, Kevin, anything that you'd like to share or that you can show us in terms of how we're using that tool and thinking about it as a guide to help look at this big potential bill of paying for college?
Yeah, thanks, Scott. I appreciate the introduction. And as perhaps several of the people watching have heard us say before, that interdependency is so crucial. So you alluded to that before. What I can show is maybe a real high level, a basic scenario, one that we'll touch on a little bit more generically in some of the slides we'll cover later. But what does it really look like when the rubber meets the road for a family trying to fund education for a student? And And funding education can take on all shapes and sizes. It can be a direct dollar amount that the family has worked backwards into to determine that's what they can afford as a family contribution towards it. And then their student is needing to make an important buying decision about where they might go, how much debt they may personally take on, et cetera. Or it could be that, we want the flexibility. We want to be able to see what would it take if the range of options was almost unlimited. And we all certainly know that the cost of education can get really steep really fast. So we'll look at a very basic scenario here, one of the reports that we produce. But what I'll highlight in advance is that this is looking at one student with a very basic goal of what would it look like with the average in-state tuition for a public school. Now, if you're in Minnesota, like we are, all Minnesota residents, you would get reciprocity with, say, for example, Wisconsin. So you could be a Gopher or a Badger, but if you want to be a Wolverine and you go one state over to Michigan, that cost might go from around $30,000 per year to north of 60 or 70. And so even within a public or private decision, there's a lot of variability. So we'll look at one, we'll talk about how we back into some of the numbers of present value of a future cost, and we'll go from there.
I just point out, Kevin, that, Wolverine is nice, but they might also want to be a ferocious fighting cardinal from Ball State University in Indiana, also for reciprocity. Well-known destination school, and comes up a lot in our conversations.
I threw you a bone at Madison, knowing that was your hometown. That's as good as it's going to get. All right, let's see what we can do here. So a very basic assumption. And again, what we're looking to do is highlight the way we back into a number. We've got a student who was born on January 1st of 2022. They've got about 18 years before, in all likelihood, they begin school. We can go through averages of what a public in-state is or a private. It's going to vary depending on the source you get it from. But we're looking at about $28,000 per year is going to be required to fund that education. Now, a college inflation rate, and again, something we'll touch on later, historically over the last, Scott, you and I have been doing this about 25 years. I want to say it's been something north of 6% per year for higher education costs, especially on the private side. Public institutions vary a bit, but looking historically, it has been north of 6 in large part. Now, moving forward, perhaps there's some compression or pressure on what that increase could be. It's been about double standard inflation rate. Some other sources might suggest that going forward, we would assume maybe a 5%, something lower, but erring on the side of margin of safety or being a little bit too conservative, we're going to use 6.
Yeah, maybe just a thought on that. I think you can make the case, as I've thought it through, and we've had a lot of conversations. You can see it's definitely public discussion now about, is college worth it, and the cost, and people championing alternatives. So I think that hopefully puts downward pressure on cost. And I think you look at technology, the availability and access to education has greatly opened up. So basic supply and demand, you would hope that puts downward pressure, or at least a ceiling on the growth of cost. And at what point does the cost simply outrun either parents' ability to pay or students' ability to repay? And I think we're there. In fact, I think we're well past there. So I think you could make the thesis that college costs should be contained, but that hasn't been the case. I think I've been saying that for 10 years, and it hasn't been the case. And even if it were true, hope is not a great strategy here. So I think we need to look at what has happened and plan for it. But as we talk about many times, we love flexible strategies, and that's kind of a key. That kind of brings us to why we like the enhancements with the 529 plan. Yeah,
Scott, great points. Thanks for speaking up there. That it is very important. And one of the shared beliefs among the team is flexibility has a premium. It absolutely does. Shining the light in the corners of tax savings and being as efficient as possible is, of course, important. It always will be. But what we don't want to do is paint someone into a corner. And so the idea that, hope is not a good strategy. You can still plan for a bigger cost, but perhaps some of those dollars need to be saved in vehicles that are not specifically for college education. And so there, even with some of the enhancements and extra flexibility that have come along with the 529 plans over the years. So in any case, current savings in this particular scenario, we're looking at a brand new family starting out, just trying to, probably still not sleeping well at night, at least in my recollection from two kids, but they're now needing to sort out exactly what this might look like and how to formulate goals. So with Ryan here, we're looking to try to save in a 529 plan. We're going to save each year through the end of college, and we're going to increase that savings rate at a 3% clip. So what might be a more general cost of living adjustment, increases to compensation, et cetera, that they're going to try to increase that savings rate over time. Now, this is the big piece. This is a really important one, that portfolio component. So how you invest the dollars makes a big difference. If you have a 6% cost increase each and every year, we know that's very steep. Can you even outpace that over what is probably an intermediate period of time? Now, if you're starting at day one, you've got 18 years. That's plenty of time for markets ups and downs. We know that's going to happen. It is a bit of a roller coaster. But later, as that goal gets closer and closer and closer, we need to pull back some of the volatility in hopes that we're not trying to pull money out during a big decline in the market, what could be, as they've laid out for us here, a great recession loss. So a 39% drawdown for that portfolio. So it might be more aggressive to begin, less aggressive towards the need for the goal. College cost, the $27,940, $28,000 per year. We're not getting any grants or scholarships built into this. Of course, that can become a little bit more clear as your student evolves, and there may be a specific program or some opportunity that would offset some of the cost. We've also never built into this the fact that there could be extra family help. And maybe we'll touch on this more later, but we see often that grandparents or aunts and uncles have set up a separate plan that we could then feed into our analysis to say, all right, there's going to be a component that is offset. But cutting to the chase, with nothing saved and a big goal ahead of us, what this is showing is we've got about a $329,000 shortfall. And so if you were to save in the more tax advantaged option, that 529 plan we'll get more into, it's about $6,600, $6,700 per year that's needed. Or, and this is where I think it can be really helpful for folks, as we look and distill down cash flow, your monthly budget, we all know what we pay for our cell phone. We all know what the garbage bill is, but trying to figure out what should be that component for college education, if that's a goal we really want to anchor to. In a 529 plan, we see that to do so, again, over 18 years of saving with that 3% increase, you've got to begin at about $557 per month just to keep up with that rising cost and what is a really big price tag, and probably one of the biggest purchases our clients make in their lifetime. On the taxable side, and this is pretty interesting, it becomes a much bigger number. You gain flexibility, but that lump sum, present value to today, that's about a $26,000 difference if you wanted to fund it as a one and done scenario. So this is the meat of the analysis, adding in multiple students, gifts from family, expectations about potential increases or decreases to funding rate over time, and on, make this a whole lot more complicated. But ultimately we get to that spend number, and what we can see is the 28,000 a year or so at the point when that student at that 6% inflation rate, that student, when they get to 18, is going to have to be able to spend about $75,000 per year. So they're big numbers, Scott.
They certainly are. They're eye-popping. It's like buying a house or a couple houses, depending on how many kids you have. I think that's a great point. Maybe to back up a bit, our planning process, we're not telling clients you have to do this or this is what you should do. We start with goals and objectives, a lot of questions, learning about people. I think one of the interesting things that we've all seen is you can have families that have they look very similar on paper, but have very different attitudes towards how much they feel like they should commit towards paying for their kids' college. I mean, the complete spectrum from education is very important. We want to pay everything no matter where they go. Boom, that's their commitment. And they want us to look at these numbers and tell them, how much do you need to commit for 4 years anywhere, and factor in that inflation you're talking about. That's one end of the spectrum. And, then the other one, we have people who say, hey, education is very important, but I earned my way through it. That's part of the education. I want to take it seriously. That's a big deal. And so that's, zero, that we have that. Very often we're finding there's a lot of people say, hey, it's important. We want to help. We want to facilitate. We know that it seems like it's impossible to effectively work your way through college these days. It just doesn't work that way. When you look at the numbers with the way costs have elevated versus where wages are at, help us earmark something. What would be 4 years at a public institution in state? We'll cover that. That's our commitment. Additional dollars, we'll have to talk about it, see how that impacts our retirement or other things that we want to do. And so the nice thing is, we can look at those different things with this tool. And I think we are big fans of education. I just, in one of my Money Matters radio bits a couple months ago, commented on a Wall Street Journal article, a big feature they had about, is college still worth it? Kind of this public discussion topic right now. And the takeaway is, on average, yes, it's absolutely worth it, but it's also very, very easy to overpay. And so I think, kind of my general thought is, people should invest more thoughtfully in an education, and too many people overpay for it, at the same time. And so, but like anything else, I think if we do have a core philosophy in here, it's, don't buy it if you can't afford it. And how do you answer that question if you can afford it? That tool you just showed, Kevin, is one segment, one module, I guess you would call it, out of the overall financial planning tool, which helps answer that question. We put all the pieces of your financial life together. Can you afford that out-of-state University of Michigan, or should you be looking at in-state University of Minnesota? And I think, another piece we did a year ago had Cozy Whitman on, who's a college planning expert. We did a webinar like this. It's on my blog, recorded, talked a lot about the research. And this just backs up research I saw over 20 years ago, that all things held equal, if you have a good student and they go to elite private expensive school, or they go to relatively affordable in-state school, they're going to end up in the same spot on average 10 years, 20 years down the road. It's more about the student, how they go to school, what major they choose, rather than the school, if you're thinking about from an investment standpoint or trade-off. So,
Yep.
Yeah. Very good. Very good. Thank you, Kevin. And that is useful. And so, like I say, we like to work with people, figure out what are their goals, what do they want to plan for, and, a different approach instead of targeting a specific cost. Something I think that comes to often, Derek and I just worked on a similar case with this, is not a hard goal of a certain amount of college or a certain type of school, but more looking at cash flow and budget and saying, what is left over? What can we commit to college, and what is that likely to grow to? And that's very useful as well, because then that helps frame the discussion as that student's moving along and say, well, I've worked with my planner over the years, and this is what I'm able to commit. So, you should not spend more than that, or much more than that. Let's be thoughtful about the college purchase decision instead of it being kind of a blank check. I think that's one of the big mistakes I've seen is, many families feel obligated, and it's sort of a scary topic to broach, and they don't want to disappoint their children, and they feel this obligation for to just be sort of anywhere you want to go. And to me, at least, that's not the right way to do it. So it's when our family plans a vacation, we talk about a lot of options, but it's not anywhere, unfortunately. there are limits. I don't know, Derek, how do you do it?
No, I was just gonna say it's a good, I think a good discussion to have with kids, when it's an appropriate age for them to kind of understand budgeting, and to point that there are limits to all of this. So we kind of live within our means. And so kind of what's the best way to do it. And then it'll help them to have a little agency over that decision. So if you're looking at funding 25% of a public school education, and you have X amount of dollars to spend, well, it's a good kind of framework to think about from the student's perspective, prospective student's perspective. Where do I get that extra money from? Do I work? Grants, scholarships, looking into those sorts of things can be really useful.
Yeah, and I think one of the things we've seen parents be pleasantly surprised when they've had conversations with kids. Oftentimes that future student very respectfully said, well, I don't want to put you in a bad spot. And when they understand that, hey, we want to help, we want to make this work, but it's not unlimited, very happily, often the student is coming back and saying, well, they don't want to put parents in a bad situation. They want to come up with something that fits, but they need to know and understand that there is a big difference, and hey, mom and dad maybe aren't able to just pay for anything. So with that, I think that was good discussion on thinking about the cost and planning for the cost. We talked, so we're going to talk specifically about 529 plans and really some of the updates. Derek, if you're talking to a client and the topic of a 529 plan comes up, how do you start describing that? What do you tell them about a 529 plan?
Yeah. I mean, just at a basic level, a 529 account is an investment account that offers some tax benefits when used to pay for qualified education expenses for a beneficiary. So these accounts can be opened by almost anybody. Parents are obviously number one kind of consideration, but grandparents are also great at getting these established. Related family members, maybe aunts, uncles, which is also a fun discussion topic amongst family too, because we do have a situation where, maybe an aunt or an uncle of a child doesn't have kids themselves, but they do want to provide some assistance in the education bucket. So that's kind of a fun discussion to be had, or even family friends can open these accounts. But the 529 functions like a Roth IRA. So the account is getting funded with post-tax dollars, and usually is held by a state agency. You can invest the money in stocks and bonds. Then when that money is spent on qualified education expenses, the distributions are tax-free. So there's some slides that we're going to get to shortly as to what a qualified education expense is exactly. There are some stipulations around them, and there are some things that are not included. So we'll get to those. But there's really two types of 529 plans. There's the one that is most referred to, which is just a college savings plan. And then there is a prepaid tuition plan, which Kevin will talk about here in a bit. Couple other items that I would probably review with clients that are thinking about opening a 529. They're really flexible in terms of contributions to these plans. Contributions in excess of the annual gift exclusion amount, which is $17,000 for this year, does count against your lifetime estate and gift tax exemption. So that's one thing to kind of be careful with, but they are really flexible. You can make large deposits into these plans with little ramification. And then on the back end of this, and Scott alluded to it earlier, we used to be a little more careful with 529 plans with regard to not wanting to overfund the plans, just due to the fact that if you do overfund and you don't use those dollars for qualified education expenses, there's a 10% penalty on the earnings in that account, and the distributions that are taken out, the earnings are also subject to income taxes. So it is best to use these accounts for proper qualified expenses. And then on the other side, as Kevin mentioned earlier, you can fund it with or use a taxable account to fund these, but the 529 advantages at this point, if you're going to be spending them on education, just kind of far outweigh the taxable account.
Great, thank you. Nice overview. And I know you put together some slides for us.
Yes.
These are actually from JP Morgan. One of the things that they do very well is make informational type materials. And so as we're looking at some things to share, I know you put together a packet, maybe we can pull that up, and a few of these we'll just touch on kind of quickly and then spend more time on others. This relates to Kevin's topic here about the cost over time. And you can see for an 18-year-old, currently public school, on average, 100,000, private school, 230,000, and then, on down to what you might be looking at for a newborn. So the numbers are big without a doubt. And so it's a day in and day out conversation here in the office with many clients. And in our household, we have 19, 17, and 7. So it's around the kitchen table as well. So
Can't escape it, Scott.
No, it's on my mind. I think, on that right hand, the box there, it shows the diplomas and the costs, and it says 81% of families have to rule out some colleges because of cost. I would say good. They should be thoughtful decisions. And so what we want to do is help people very smartly plan for and save for within their means. But
yeah. And I like that stat too. So I'm a newer parent myself, and I think some parents, at least like myself, have want to provide as much as possible. But this 81% number is a good reminder to let you're not alone in considering costs when it comes to college. Majority of people are doing this and having conversations with kids, and it's affecting their decisions.
Yeah, very good. Let's take a look at the next one here. So to me, the big story, and we've seen headlines after headlines, there's debates, there's legal actions going back and forth about student loan balances, but on the right-hand side there, where they're looking at the growth in balances between student loans, auto loans, credit cards, home equity, 2005 to 2022, 330% increase in student loan debt balances. Really shocking. And we love compound interest, but it's one of those things where, compound interest can be a very useful servant when it's working for you, but it's a terrible master working against you. And so this is the situation that we really want to try and avoid, or at least be extremely thoughtful about taking on this type of debt. What is it being used to purchase, and will there actually be a financial payoff? Okay, so this is where it gets interesting here. You're starting to talk about 529 plans. There are some other tax advantaged vehicles that we discuss in some cases. We were just looking at UGMA account for a client that's been in place for a long time, Coverdell Education Savings Account. Really, we're focusing on 529 plans, but say, the list doesn't stop here. You can use, Derek mentioned 529 plans work similar to Roth IRAs. Well, you can access your contributions in a Roth IRA, and to some extent gains as well, with certain limitations or penalties, but certainly contributions could be used as well. Is that the right vehicle? We'd probably prefer not. Let those dollars run and stay in the plan as long as possible. 401ks, you can borrow against a 401k. Probably also not our favorite approach, but it is something that's used in certain cases. It's good to know that there's just lots of tools in the toolboxes. You're not specifically limited to these designated college savings plans. Real estate, some cases people will buy a property and have it paid down over time and build up, and use that as something to help pay for a college. That's certainly there. What else, guys? What do we hear about? Here's a cautionary tale, I guess, and say, financial advisors who are paid to sell products, and in particular more insurance based, are often touting permanent life insurance as a college savings vehicle. I would urge extreme caution here. It is true there are some tax advantages to that cash value in the insurance policy, but you really have to weigh those against the extra cost drag associated with the insurance policy. The loads on the dollars going in, the internal expense ratio, the insurance costs, and if that money comes out, that you're paying for more insurance cost internally. So really not something we're typically recommending unless, maybe, hey, grandpa and grandma have a seasoned whole life policy with money in there, and say that the risk of needing that insurance benefit has gone away. Maybe it's a good use for the cash value at that point. But one that's not on here is just regular taxable brokerage investment accounts, and that is something that we've actually recommended as part of the savings plan for a long time, and in particular winding back the clock to when 529 plans were much less flexible. And that can be invested in a very tax efficient manner. Those dollars can be gifted. Parents, grandparents, anyone can pay directly to an educational institution without having to stay within the annual gift tax limits that Derek had mentioned. And so there's a lot of potential advantages. Back when we looked at excess 529 plan balances potentially being subject to income tax on gains and a 10% penalty, versus the brokerage account being taxed at capital gains rates on the gain, and or maybe a step up in basis and those dollars never being taxed. If it's a situation where it's a grandparent maybe wanting to help plan for college, I think it's worked very well in many cases when used appropriately to just have regular after-tax investment account. What do you think, guys? Anything else that's worth mentioning on this slide?
Spot on.
Derek, maybe if we could skip ahead to the slide that's called the 529 plan advantage. I think it's 3 slides ahead. So I think this is one where it starts summarizing some of the real benefits here, and maybe we can highlight some of the changes. So the blue box, the tax advantaged investing, Derek did a nice job of explaining how that works. Kevin pointed out in the projections, the power, that extra power. What was it, Kevin? The extra $28,000 on that lump sum, almost a quarter of the balance extra by having it be tax free. So big advantages there. Estate planning benefits. I think this is where it gets kind of interesting, especially, very often we're working with the parents, but grandparents seem to love to be able to help pay for college too, if they're confident they're in a situation where they have excess dollars. We're probably talking about legacy money. And Kevin, you and I have worked on some cases. We've been talking about how we're looking at that planning tool and using that to help identify legacy funds. What do you think about the estate planning side of 529 plans?
Well, I think it's a fantastic opportunity. I think in some cases, perhaps in the ultra high net worth market, it's being used as a tool that could end up painting someone into a corner with some of the flexibility issues and perhaps not a bona fide use of maybe the spirit of the plan. But I do think for families that have looked to make contributions, help out with that college education cost, and let's just say grandparents are in a position to be able to make contributions to that next generation or to their grandkids, this can be a huge opportunity to get money out of the estate to effectively pre-fund the education. And the benefit is we go into the yellow there, that control and flexibility. There is the opportunity that even if the plan for a designated grandchild ends up being overfunded, if there are other kids, niece, nephews, et cetera, that there are ways to repurpose those dollars for a beneficiary that might actually be able to use them. So it can be a win from a multi-generational estate tax planning strategy standpoint, but also from a multi-generational education funding standpoint.
Yeah, it's quite unique, that green box, the ability to make 5 years worth of that annual gift up front and get a large lump sum in there. And then that last bullet point they mentioned, this is really one of the only tools where, if you are that grandparent generation, or even that parent, if you've done well, corporate executive with large liquidity event with your company or something along those lines, you can front load those 529 plans with a large gift and essentially build a bank for education funding. And you touched on it, Kevin. So it's outside of the taxable estate when we're estate planning purposes, but the grantor still has control. It's very unique. Change the beneficiaries and move it around. And so very unique tool. We've brought Leslie Geller on, who's the National Advanced Planning Director for Capital Group, very sharp tax and estate planning attorney, and done one of these webinar sessions with her. And she's talked a fair amount about the concept of, really a dynasty 529 plan by, having, using this to remove dollars that would otherwise be caught in the estate tax off the estate tax ledger, but still having control and using that power of tax deferral. So very advantageous. And maybe even more modest means, one of the new changes, one of the things I think we wanted to touch on is, Derek, there's this ability now to leak excess money out of a 529 plan into a Roth IRA, right?
Yep. Yeah, so we covered this in our this was one of the Secure 2.0 Act changes, where you can take excess dollars from a 529 plan and roll it into the Roth of a beneficiary. It's still subject to some rules and regulations that we got into in that call. We're happy to send out another link after this call, but high level, the beneficiary still needs to have earned income to be able to complete this rollover. The 529 plan has had to be in place, but for 15 years, as well. So it can't be a new 529 plan that's established, the year prior with a whole bunch of money, and then you start doing this rollover strategy. That can't happen. And it is still subject to, the standard contribution amounts within traditional IRAs and Roth IRAs. So that would be $6,500 for this year.
Yeah, and I think it's $35,000 max per beneficiary. But interestingly, the contribution limits apply, and they have to have earned income, but the income phase out is not there.
Yep.
So it's really interesting. Whereas if you go back, 10, 15 years ago, I had concerns about, okay, you've built up dollars. What if child gets a scholarship, or they go into the military and get their school paid for, or they launch a trade or business, or any other, great things that could happen? There could be excess dollars, extra money left in the 529 plan, even though it seems far-fetched when you think about the costs we just highlighted, but it could happen where there's excess dollars left in a 529 plan. You go from this great tax-free college planning vehicle to, boom, ordinary income tax rates and a 10% penalty. But now the ability to leak out, $35,000 into the beneficiary's tax-free Roth IRA, that's pretty fantastic, especially if you are that grandparent level, and like Kevin's talking about, in a high net worth situation where you've identified that, hey, there's probably a fair amount of my balance sheet that's legacy funds. This could be a really great parking spot for that, knowing that it's either used to pay for college, or can be used to pre-start that Roth IRA and just continue the growth.
One more thing I wouldn't mind pointing out on this slide, but this second bullet point under the yellow section, can change beneficiaries or transfer unused assets to certain other family members. It's a really nice option with the 529s. However, one thing to kind of be careful of, and we just ran into it with a recent client situation, is maybe you have a pretty substantial age gap between your children. And, typically 529 plans, when they're set up, you can set them up on what's called like a glide path, where over time, as Kevin alluded to, it's reducing the volatility by taking money from equities and putting it into bonds. So because those kids are on separate kind of glide paths, the younger kid, you want more exposure to the volatility, to equities when they're younger. Maybe you have the older kid. So it might not be a bad idea to have two separate 529 plans for each kid in that specific case. So I did want to mention that as we just ran into it.
Yep, that's a great point. And like over in the right hand column, the 529 plans are easy to set up. They're low cost. There are good options, I think, for the DIY, kind of simplistic, the target date type options work well. We often get a bit more strategic in terms of deciding which investments to hold in the 529 plans. But yes, absolutely, you want to match up the risk tolerance, but the timeline as well. and having everything in one pot can confuse the issue. Like Derek's saying, if you have kids spread over a large timeline, like we do, we would want a more aggressive profile for our youngest, who's just graduated first grade, and really a conservative pool for our sophomore in college right now, who's taking funds out. So very good point. But you can change the beneficiaries, including back to yourself. And I keep looking at, gee, maybe a PhD at the University of Hawaii in my sunset years might not be bad, and pay for part of that out of tax-free 529 plan dollars. So let's see. Yeah, the next slide is a good one as well. I think this talks about some of the expenses, and this is one of the other exciting areas. So the ability to roll money into the Roth IRA is a newer development, and a really good one. And some of those areas in the green are newer as well. But any things you guys want to touch on or throw in here in terms of qualified expenses?
I had on the education loan payments that you can use $529 for. There is a $10,000 lifetime limit at this point in time. That's subject to change based on new laws and regulations that come out, but that is one item to note there.
Yeah, and that's a new one. So that's another way to kind of leak excess dollars out, or just an enhanced flexibility that is newer. I think we've had conversations sometimes where people say, I want my student to have skin in the game. I've used that term, and one family in particular said, hey, they had to pay what they could pay. They took out loans, and if they did a good job, I came in and helped repay them. And they were very happy with how that worked out. It's encouraged the student, I think, to make a very thoughtful decision about where they were going to school and what major they're choosing, those types of things. But it also, really incentivized, the work and participation. But now you can use 529 plan to use up to $10,000 to pay that off. Or, hey, family situations change and evolve, and sometimes new family members are coming in through a second or third marriage or something like that. And if there's existing 529 plan, the ability to maybe use some of those funds to help someone pay off existing loan balance with tax-free dollars could be really great. The K through 12 is I forget which year and when that came in, but that is newer. And I think probably where we're looking at that is, what would you say, Kevin? Usually that might be more of a grandparent funding, just because of the shorter timeline rather than, usually parents. It would be a real challenge to say, are we using 529 plan to pay for that, or try and get more bang for the buck with tax-free accumulation for college?
Yeah, that's a great point. And I think therein lies a bit of the nuance with individual planning circumstances and a given family situation. Generally speaking, we highlighted that taxable account versus 529, the advantage of that tax deferred growth and then tax-free withdrawal. In all likelihood, these are also families going through the power stroke of their career. Income has increased. That marginal tax rate with which they would be paying on a taxable account at, dividends, interest, capital gains, et cetera, that's becoming quite punitive. Getting some of those dollars to spend for earlier expenses helps in a couple ways, whereas kicking the can down the road, allowing for additional time, value of money, benefit with those $529 is usually helpful. So more often than not, for students that we would see wanting to attend, some sort of college career, it'd be best to wait to use those dollars for later in life. And then, it's going to depend on the makeup of the family situation. But even for the grandparents, oftentimes it might feel like, boy, private school is going to be a big cost out of pocket right now. But getting your bang for the buck on that tax accumulation or the tax alpha there, it's going to be best to wait. So we always work with people and try to figure out the exact right lane for them to stay in.
Yep. Kind of a fun one here on the slide, the apprenticeship programs. First of all, I think this is wonderful. The ability to use these dollars to, get into the trades or vocational type school, and not just, traditional college, I think is fantastic. That definitely is the right route for many people. And I think, we could say we've seen some clients who've done very, very well in construction industry, electrician, a number of things come to mind over the years. So fantastic route. But one of the really kind of fun ones with sort of my side passion for wilderness travel and guiding trips is a number of the outward bound programs you can pay for now as a qualified 529 plan expense. So studying expedition and outdoor leadership. And I'll give a shout out to my friend Tim Smith, who runs Jack Mountain Bushcraft out in Maine, where I did his river guide training program. This wasn't available when I did it years ago, but that actually is a qualified 529 plan expense. So if there's some extra dollars left over, or your student's really passionate in one of those areas, good use for 529 plan dollars as well. So maybe just one more slide here, Derek. I think if you advance two, there's the family legacies with 529 plans. So we've talked a bit about this concept. Here's a nice visual. And typically when a financial planner or someone's using an online calculator and they're looking at projecting long-term retirement projections or college projections, often it is adding in the assets, adding in income, adding expenses, adding assumptions for rates of return and inflation and taxes, and projecting that outward and ending up with a number. It used to be sort of a deterministic time value of money number of certain dollar amount. More often, we're fans of Monte Carlo analysis. We think that's a useful tool for the sensitivity analysis. It might give you a probability of success type number, but we've been talking more and more, especially for higher net worth households, of saying, okay, we know you've won the game, so to speak, in terms of covering your cost and your expenses. How much, using that tool to identify what might be excess, what would be an estimated legacy amount of capital, and what's the core amount of capital. Here again with the estate planning, the ability to use a 529 plan or several of them to put large upfront gifts in. And this is illustrating a large gift when a child's born, the money grows up till college, and then college funds withdrawn, excess funds, and the money can continue to grow, and beneficiary could be changed along through the family. So very interesting opportunity to remove some of those dollars that would otherwise likely face, an effective 50% tax in terms of estate taxes, but still retaining quite a bit of control over the use and purpose for those funds. So, with that, there's a lot we could talk about here, but we hit a few highlights. I'd really encourage people to, give us a call if you have more questions, want to talk through some of these options. Everyone's situation is different. Their students are different. Their desires for what they want to do planning wise are different, and we can help think that through and work it through with you. So with that, and again, we do have other related sessions. The one I think with Cozy Whitman on the purchase decision around college was great. We had a lot of research that we pointed to there, and she had wonderful tips about evaluating institutions for students. Very, very good. So with that, we'll wrap it up, and look forward to joining you again in a future session. Thanks all.
Thank you.
Thanks, everybody.